In today's lesson, we are going to look at one very important topic in accounting. It's basically a subset of a topic. It's a method that is part of methods used in preparing or calculating depreciation. It is called sum of the year digit method. Sum of the year digit method is a method that is used in calculating depreciation. We have other methods one can use, or a company or an organization can use to calculate the depreciation. It depends on the policy of the company. We have the likes of straight line, reducing or diminishing balance method. We have the revaluation method, disposal of asset method. We have depletion, amortization, and so on and so forth. But for today, we want to limit our interaction or our discussion to sum of the year digit method. Very quickly, let's look at what we call the lesson objective, what we serve as a focus of our interaction, what we intend to achieve in today's lesson. Number one, we want to look at how the sum of the year digit method looks like. How will you be able to differentiate this method from other methods? If you are given a question and the examiner specify this particular method, what are those parameters that you need to understand that will help you to have a success, or that will help you to calculate the depreciation using this period? Now, when we are done with that, we now solve related problems. There are problems that are related to sum of the year digit method, and after that we are going to post the provision for depreciation to the necessary account. Now, at the end of the lesson as well, we want to be sure if we've been able to achieve our objective. We call it success criteria, things that will determine our success story. Number one, if at the end of the lesson we are able to describe the sum of the year digit method, solve related problems, and then post provision for depreciation into the necessary account. Very quickly, let us see if we'll be able to describe the sum of the year digit method. We said sum of the year digit method, we can look at it in three different ways. Number one, I want us to understand that when you talk about sum of the year digit method, is actually looking at a decreasing depreciation that is computed by a simple mathematical procedure relating to the arithmetical progression. This particular method is going to borrow a whole lot of mathematical procedures. There are so many terminologies, mathematical terms that this method will borrow to be able to bring the message home. The second thing is that each year of an asset life should be represented by a digit. And then you add this digit and charge fractions of the asset cost to the years in reverse order. What do I mean? What I mean is this. First of all, I said a decreasing depreciation is computed by a simple mathematical procedure relating to arithmetical progression. In mathematics, that's what we call AP, arithmetical progression, where you have a series of numbers that is arranged in a particular pattern. We always encourage students that if you want to take a course in accounting, you must make friends. You must have a good relationship with mathematics, because there are so many things that the accountant, so many mathematical tools, so many mathematical procedures that the accountant will always borrow to be able to get a successful accounting practice. So in this case, we are going to look at how this AP, this arithmetical progression, will help us to get this depreciation, to calculate or to ascertain this depreciation. The second thing is, I said that each year of an asset life should be represented by a digit. We are going to use a digit to represent the asset life, and then we add this digit, and the fractions of it will now become the asset cost of the asset in the reverse order. Very quickly, we don't need to talk much. We want to quickly look at an illustration. It is this illustration that will now bring the message home. Everything we have said under this this description is going to be demystified in the illustration we are going to look at. Let's look at this illustration. It says a machine was bought in 1995 for 5,500. It was estimated to be 500 naira after 4 years of use. They say you are required to use some of the year-digit method to, number one, determine the depreciation rate. Number two, prepare the depreciation schedule. Number three, you are expected to post provision for depreciation into the necessary account. Please, let's don't forget that companies can choose to use any other method. We have the straight line method, we have the diminishing balance method, we have the revaluation method, we have the disposal of asset method, we have the depletion method, we have amortization method, different method depending on the method the company will want to use. But for the sake of consistency as a concept in accounting, any method that is adopted, the company should be consistent with it so that they can prepare they can have what we call a comparative account system. A comparative accounting system is a system where you compare the result of an account of the previous year with the result of the account of the current year. If the company if they are not consistent with the method of calculating depreciation, they may not be able to get a reliable result as compared to in the current year as compared to what is obtainable in the previous year. So we recommend strongly that even if we have different accounting, different methods used to calculate depreciation, companies should adopt a system or a method that they can be consistent with, so that when it is time to compare accounting years, they will be able to say, okay, this is what we realize this year as compared to last year, and this is what we should expect for next year. All right, let's look at it. The first one is that we should determine the depreciation rate. First of all, the depreciation rate, what you are going to get, first of all, you are going to subtract your cost from your residual value. That's the very first thing. The depreciation, first of all, you are going to subtract, this is the cost, minus what? Residual value. So in the question, the cost is what? The cost is 5,500. So you have 5,500 minus what? Minus 500. This will give you what? 5,000. This is supposed to be the depreciation. Supposed to be the depreciation. But what we are looking for is depreciation rate, not depreciation. We are looking at the depreciation that should be charged in each of the 4 years of the asset. So like we said from the beginning, we said that this is going to use an AP, arithmetical what? Progression. So what you are going to do, you have the years of the asset, and then you have the digits. So the years of the asset is 1, 2, 3, 4. Now the digit is going to start from 4 in a reverse order. You have 4, you have 3, you have 2, you have 1. Now when you add up this, look at what I'm doing. When you add up this, 3 plus 4 is 7, plus 2 is 9, plus 1 is what? 10. Now this is what we call the arithmetical what? Progression. Can you see this now? This is a mathematical procedure. We have adopted this now, so we'll be able to get the depreciation rate. Once you have on the years, we have first year, second year, third year, fourth year. Now on the digit, you have the fourth year, third year, second year, and the fifth year in the reverse order of the years of the asset. So that if the asset is 10 years, 4, 5, 6, 7, 8, 9, 10, you are still going to start from 10, 9, 8, 7, 6, down to 10. And then you now add up this. The truth is, if you still add up this, you will still have 10. But we are interested in just the digit addition. Now, if you have understood this, let us now make progress. For year 1, let's start from here. You are year 1 now. Now, for your year 1, you are going to have, it's going to be 4 over 10 times 5,000 over 1. So year 1 is going to be 4 over 10 times 5,000 over 1. What is the value there? Let's manipulate it together. 0 will cancel 0, and then you have 4 times 500 is going to give you 2,000. That's the depreciation for year 1. Then for your year 2 is going to be what? 3. Year 2 is 3. Going to be 3 over 10 times what? 5,000. 1, 2, 3 over 1. 0 will cancel 0. You are going to have 3 times 500. It's going to give you 1,500. And then for year, this is year 2. Then for year 3, it's going to be what? 2 over 10 times what? 2 over 10 times 500, 5,000 over 1. 0 will cancel 0. You're going to have 2 times 500. It will give you what? 1,000. And then for year 4, you're going to have 1 over 10 times 5,000. 0 will cancel 0, and you'll be left with what? 500. So this is what is expected of you. Now, the depreciation rate is going to be what? 2,000 for year 1, 1,500 for year 2, 1,000 for year 3, and 500 for year 4. I want to believe that at this point, students will not find it difficult. First of all, you subtract the cost, subtract the residual value from the cost. When you subtract the residual value from the cost, you're going to have 5,000 as a depreciation. Now, let me ask a question. Have you seen why we said 5,000 naira is a depreciation? Let's add 2,000 plus 1,500, that's 3,500. Plus 1,000, that's 4,500. Plus 500, that's 5,000 naira. So the only thing you need here, the depreciation here, is just the summation of the depreciation for the 4 years. That's why we call this 5,000 depreciation. But this one cannot give you a breakdown of the depreciation for each year. What the examiner is looking for in this question is the depreciation rate, the depreciation that is chargeable to each of the year of the useful life of the asset. And then for you to do that, you are going to present it in this form. You are going to use a mathematical procedure called the AP, arithmetical progression, where you arrange the number of years based on digit and the years. You have 1, 2, 3, 4 because the asset will last for 4 years. And then you arrange it in a reverse order and arrange it under a digit called the 4, 3, 2, 1 digit. When you add it, whatever you have there will now serve as a basis on which you are going to now charge the depreciation rate. So the first year is going to be 4 over 10 times 5,000, which is 2,000. The second year is going to be 3 over 10 times 5,000, which is 1,500. The third year is going to be 2 over 10 times 5,000, which is 1,000. And the fourth year is going to be 1 over 10 times 5,000, which is 500. If you have done that, there is no examiner in this life that will toil with your score. You have gotten it 100 over 100. That's question 1. Question 2 is prepare the depreciation schedule. Let's quickly prepare the depreciation schedule. We are going to maximize our board. We're going to maximize this board. All right, let's quickly do the depreciation schedule. Depreciation schedule. Depreciation schedule is always 5 columns. The first column is the year. The second column is the cost of asset. The third year is the depreciation. The third column is depreciation. The fourth one is accumulated depreciation. And the last one is net book value. So this asset is just for 4 years. So you are going to rule 4 columns and rows. Now, this is the way it is. This is year 1, year 2, year 3, and year 4. Now, let's start with the depreciation. The depreciation for the first year is what? Is 2,000. Second year is 1,500. Third year is 1,000. And the fourth year is 500. Now, the cost of the asset, remember the cost of the asset is 5,500. Now, if the cost of the asset is 5,500 in year 1, once you have subtracted, you have removed 2,000 from the asset, the cost of the asset will drop to what? 3,500. And then when you remove depreciation of 1,005 from here, from 3,000, the cost of the asset will reduce to what? 2,000. And then when you remove 1,000 from it, the cost of the asset will reduce to what? 1,000. So this is how the cost of the asset goes. 5,500, 3,200, and then 2,000, and then 1,000. Then the accumulated depreciation just now is simply this depreciation. This is depreciation for year 1. And then you add this to this, you have 3,500. Add this to this, you have 4,500. And then you add this to this, you have 5,000. You have 5,000. You see, you have what? 5,000. So now let's quickly look at it. The net book value, subtract here from here, you have 3,500. Subtract here from here, you have 2,000. Subtract here from here, you have 1,000. Subtract here from here, you have 500. So if you look at it, I always say this, that whenever you are preparing your depreciation schedule, the value you are going to have here should always tally with what is given to you in the question. What were you given? You were given 500. 500 is the amount of money given to you as the value of the asset after 4 years. So what you have here must always tally with what is obtainable in the question. So to prepare this table is a very simple procedure. Where the challenge is how to be able to get this. And I am very sure that if you know how to use your proportion, you'll be able to manipulate this in maths. Mathematics is this part of mathematics is a very simple procedure. Just once you get this, to prepare the table is not going to be difficult again, because your depreciation will now determine the cost of the asset. Once you get your depreciation, you can get your asset. Just subtract the first depreciation from the original cost of the asset, and you will get your subsequent cost of the asset. Once you have gotten all of this, you can now look at the posting. Now the posting, I have said that 4 different accounts are involved in every depreciation that one is expected to prepare. And these accounts are 1, asset account, 2, the second one is the profit or loss account. The third one is what? The provision for depreciation account. And then the last one is the what? The balance sheet. Let's quickly look at the asset account. The asset account is what? A machine. We say machine account. Machine account, this is your credit side, debit side. And then your machine account, you have, what is the date? Okay, 1995. 1995. The cash, what did we buy? We bought, that's 5,500. And then your balance here, balance carried on is 5,500. That's it. You have concluded that. It's as simple as that. When anybody that look at this account, we know that this value, since we have the cash here, the corresponding entry to this transaction will be in the cash book. And then the second one is the profit or what? Loss account. The profit or loss account is an extension of the profit of the trading profit or what? Loss account. The trading profit or loss account. Now we have said that in preparing your trading profit or loss account, it is that part of the account that takes care of expenses only. It looks at the expenses incurred within the period you are carrying out your business. And as a matter of fact, don't forget that whenever you are carrying out your business, the expenses that will be involved in the business depends on the nature or the type of business. What is obtainable in manufacturing company is different from what is obtainable in construction company, and so on and so forth. But for the sake of what we are doing, we know that depreciation is a subset or is just a segment or an atom or just a part of the expenses of a business. That is why it's going to look like only depreciation will be lined up here. But in the real sense of it, profit or loss account encompasses all the expenses under review. So you have 1995, you have depreciation. You have depreciation for 1995. The first one, we have the depreciation. Let's not forget our depreciation that as we calculated, that the first one was what? 2,000. The first depreciation was 2,000. The second one, 1996. Depreciation was what? 1,500. And then for 1997, depreciation was what? 1,000. And then for 1998, depreciation was 500. So these are the various depreciation. These are the what? Various what? Depreciation. So whenever you have done this, anybody that look at this will know that 1995 depreciation is 2,000, 1996 1,500, 1997 1,000, and 1998 is what? 500. All right. Now, let's look at the next one now. The next one now is what we call provision for depreciation. Provision for what? For depreciation. Provision for depreciation. Now, provision for depreciation is a liability account provision for depreciation account. Provision for depreciation account. You have provision for depreciation account. Now you have your 1995 here, 1995 here, and then your profit or loss for the first year is what? For the first year is what? 2,000. And then you come here, 1995, you have balance carried down is what? 2,000. So that will be for 1995. Then you come here, 1996, you have your balance brought down 2,000, and then you add profit or loss. That's 31st December. You can write 31st December, P or L is what? 1,500. So you have 3,500 here, and then you have 1996, 31st December, you have your balance carried down. Your balance carried down is what? 3,500. So you have 3,500 to close up the account, and then you come down again, you have 1997, you have balance brought down is 3,500, you add 31st December, profit or loss is what? This is 1,500, the other one is what? 1,000, which is what? 4,500. And then you have 1996, 31st December, balance carried down 4,500. You have 4,500. And then the last but not the least is 1998. You have your balance brought down is 4,500. And then 31st December, your profit or loss is going to be what? 500. And then you have 5,000. And then here you have your 1998. You have your balance 31st December. 31st December balance carried down is 5,000. And then you have 5,000. So this is how to prepare your provision for depreciation. So anybody that accesses this account will know that in in 1995, the depreciation you have here, this is 31st December. Oh. Your P or L is that. And the same thing is applied to this side. 31st December, your balance carried down is 2,000. So anybody that look at this account will know that these values, they are the value for your depreciation. The depreciation from the beginning is 2,000. Now this is the one for first year, 1995. The one for 1996 is going to be the one for 1995 plus the one acquired in that year. The one acquired in 1996 is 1,500. When you add it to the one of 1995, you have 3,500. This is what is expected to arrive at in 1996. So for you to start 1997, this balance must be brought forward, which is 3,500. Depreciation for that year is 1,000. When you add that 1,000 to 3,500, you have 4,500. That's the depreciation for the year for 1997. Now for 1998, the depreciation for 1997 will begin that of that year. That's why we have balance brought down, 4,500. And then the depreciation for that year is 500. When you add it to it, you have 5,000 naira as the depreciation for that year. So if you subtract this 5,000 from the original cost of the asset, which is 5,500, you'll be left with 500 naira that is given as the residual value of the asset. Very quickly, we're going to look at the last part of the account that is expected to be prepared, which is what we call the balance sheet, or what we call the statement of financial position. This statement of financial position is a statement that is prepared to ascertain or to give a clear picture of the assets and the liability of the company. You just write balance sheet, and then don't forget to put your T sign, because all along is T method that we are using. And then you have 1995. What is the name of the asset? It's called machine. What is the value? Is 5,500. Now the depreciation for year one is what? 2,000. So when you subtract here from here, you have what? 3,500. Now for 1996, the machine value is no longer 5,500. It has reduced to 3,500. So you have 3,500, and then the depreciation is how much? For the second year, depreciation is 1,500. When you subtract this, you are going to have what? 2,000. And then for 1997, the cost of the asset has reduced to 2,000. So you are going to have 2,000, and then the depreciation for that year is what? The depreciation for that year is 1,000. So you subtract here from here, you are going to have 1,000. And then for 1998, the value of the machine is now 1,000. And then for the depreciation is what? 500. When you subtract, you're going to have 500. You're going to have 500. Now let me explain something, because this is where we want to clarify students on the difference between the reducing balance method, the straight line method, and the sum of the year digit method. Now, if you look at this, you will see that the cost of the machine from the beginning is 5,500, while the depreciation is 2,000. Now, when you subtract or when you charge the depreciation on the cost of the asset, you are left with 3,500. This 3,500 that you have here is the residual value, or what we call the net book value, or what we call the scrap value of the asset at the end of year one. Now you ask me, sir, how do we ascertain this? How can you see an asset and you say, this asset that I'm having is 3,500? There is no physical description of this value. The asset, it does not be written anywhere on the body of the asset that this asset is now but this is the book value of the asset. When you approach the account, okay, so now we have completed this. You can see now that the asset, the value of the asset from the beginning is 5,500. When you subtract the depreciation, you have the value of the asset as 3,005. That's at the end of year 1. At the end of year 2, the value is no longer 5,500. Even if the asset is still very sound, very healthy, is still producing, you will come and you will see that everything is still working smoothly. But the book value of the asset has dropped. The accountant is quietly in the office, reducing the value of the asset year after year. But on the site, the engineer, they are there, they are still using all the assets, they are still producing what they're supposed to produce, but the book value of the asset has dropped. So when you come, you approach the company and say, but I was taught in accounting that at the end of the first year, that the asset will drop in value. The accountant will just laugh. This thing you see here is just like an estimation. In the book of the only people that will appreciate what is happening here is the tax accountant. When government will come, we cannot present our book and say, sir, this is the value of the asset we have. Sometimes this value you see here, you can underestimate or you can overestimate, but it's always safe to do what? To overestimate, so that it will reduce your tax burden. So at this point now, the value of the asset has dropped, 3,005. So when you are starting the business in 1996, it is assumed that your value, the asset is no longer 5,500 but 3,005. So at this point, the depreciation is 1,500. When you subtract 1,500 from it, you have what? 2,000. When you come to 1997, look at asset that you are using, 5,500. It has dropped to this. Now, until it will now get to 1998. By 1998, your asset is just 500 naira worth of value. So if anybody approach the company and say, please, we want to buy up your asset. If you sell the asset for more than 500, it is what we call disposable profit. You are going to sell it at a disposable profit. That process of selling the asset more than the scrap value is what we call the profit realized at disposal. When you dispose the asset, is what we call to sell the asset. So at this point, the accountant will now have an idea of how much he or she will be able to sell the asset, so that the company will not be worse off. So at this point, they cannot sell the asset less than 500. If they sell the asset less than 500, it will be a disposable loss. So they are going to sell it more than 500. So now, how do we now differentiate this from others? Now, if it is straight line method, the cost of the asset will not change. The depreciation will not also do what? Change. The depreciation will just be coming. The depreciation will always be coming. If it is straight line method, if it is 2,000 here, you have 2,000 here, you have 2,000 here, you have 2,000 here, there will be no change. Please, let's note the difference now. Now, one, if it is straight line method means the depreciation that is charged in each of the year will not change. That means it will be 2,000, 2,000, 2,000, 2,000. That's for straight line. If it is reducing balance method, then the cost of the asset will not change here. The cost of the asset will remain the same. The cost of the asset will remain the same. What will be used to charge the depreciation is what we call the accumulated depreciation, not the depreciation for each of the year. Like right now, this is the one for first year. This is the one for second year. So what will be used to subtract this is 3,500. If it is reducing balance method, you will have 5,500 here. And then when you subtract 3,500 from here, you will still have 2,000. The value here will remain the same, but the subtraction process will change. Here, it will be 3,500 that will be used to subtract this. But since it is reduced, it is sum of the year digit, you can see now that the cost is changing, and then you use only the depreciation for the period. So students should take time and then study this video so they will be able to understand the difference between this process, because the examiner will take time to look at it. If it is straight line, the here will remain the same. There is only here that will change. The cost will be here, just the way the residual value is. This side will remain the way it is. But you see this change, depreciation will remain the same. That if it is diminishing balance method, what will be used to subtract here is just the accumulated depreciation. Why the cost here, it will be 5,500, 5,500, 5,500, 5,500. But now that it is sum of the year digit method, you can see now that the cost has changed. So they can ask you a question that which of the accounting method charges depreciation on the residual value? The only accounting method that does that is what we call the reducing balance, what's it called? A sum of the year digit method. All right, let's quickly go to our exam guide to see if we can get some examples from our exam guide that will help us to further explain what we have said so far. If you see on the screen, you see once you click on the exam guide, you see the information displayed on the screen. The subject is account, that's why it's stick there. And then the year, you can choose any year of interest. Here it is choose at random, and then select the interest, the topic of interest, and then you go to get started immediately. Now, look at this. This has to do with disposal of assets. They say when a fixed asset is disposed of, the accounting entries to write off the write off the asset are what? Debit disposal account and credit profit or loss account, asset disposal account and credit assets account, and then debit profit or loss account and credit asset disposal account, and then they say you should debit profit or loss account and credit provision for depreciation account. That is the answer. What you do is that when asset is disposed of, you have to debit the profit or loss account, and then you are going to credit the provision for depreciation account. That is the answer. That's D. And then the second question here, it said, they said when there is the provision for depreciation, fixed asset is shown in the balance sheet at number 1, cost less depreciation for the period only, cost less total depreciation to date. 3, written down values. They say where there is provision for depreciation, fixed asset is shown in the balance sheet at cost less depreciation for the period only. That's not it. It's cost less total depreciation to date. Total depreciation to date means both the depreciation that is charged and the provision for depreciation. So the answer is C, which is number 2, cost less total depreciation only. And then let's look at the last question. Let's look at the last question now. All right, they say a method of charging depreciation at a fixed percentage of the net book value is dash. You see now, I have said this earlier. A method of charging depreciation at a fixed percentage, percentage of the net book value is dash. Very simple. They say a fixed percentage. I've explained that if it is straight line method, here will not change. The way it is now, exactly the way it will be. 5,500 will be here, 3,500 will be here, 2,000 will be here, 1,000 will be here, but here will not change. If here is 2,000, here must be 2, here must be 2, here must be 2. But this is what we call the net book value that they are asking here. They said the method of charging depreciation at a fixed percentage of the net book value. This is the net book value of the asset. So the percentage charged here is the fixed percentage you are talking about. And the answer is what? Straight line method. It cannot be revaluation method. It cannot be sum of the years digit method. It cannot be reducing balance method. If it is reducing balance method, then what is going to be here will be the accumulated depreciation. If it is sum of the year digit method, it's going to look like this. But if it is straight line method, here will be 2,000, here will be 2,000, here will be 2,000, here will be 2,000. So the answer there is simply A. All right, so far, this is how much we can take in today's lesson. I recommend strongly that students should take time to look at previous videos on depreciation. We have looked at depreciation. We've looked at causes of depreciation. We looked at method used in calculating depreciation. And we've also taken time to solve examples and questions, related questions on this topic. I recommend strongly that students shouldn't be in a hurry to just flip through the method. They should take time to solve as many questions as possible under the various top method that we have treated so far.